The 2008 financial crisis wasn't our most recent financial crisis, but it still affects us today as gold and silver stackers and as investors in general. Hey everyone, Tactical Timmy here. I wanted to talk about the 2008 financial crisis, what it is, and how it actually still affects us today. And we'll go over the causes of it and see if we can see if there's any causes that would give us pause for concern in our modern times. So let's go ahead and talk about what was the actual financial crisis in 2008. As it is in the name, it was in the year 2008, and stocks all of a sudden lost half their value. The S&P 500 was valued up at about 1,500, and for a short time, it actually dipped below 700. So that would be half of its value evaporated. That's like if this $30 silver eagle all of a sudden was only worth $15. That would be a tremendous loss in wealth and purchasing power all of a sudden overnight. And this did happen over the course of several months, but typically people, you don't see the changes all the time, especially for people that had money in their 401ks and that kind of thing. They're not going to be checking those kinds of things every single day because they're not involved in the financial crisis. They're not involved in finance all the time. So that's what it was. It was this huge drop in stock prices. And now we really need to understand, well, what would possibly cause something to lose half its value all of a sudden overnight? Because in silver's case, or in gold's case, well, we know this is not going to drop half of its value overnight because it's got some physical properties and we know some characteristics about it, and nothing's really going to change between today and tomorrow. It's probably going to have a nice stable value. Now, in 2008, the stock market didn't necessarily have some of those good, steady characteristics. Let's talk about some of the things that might have caused the 2008 stock market crisis. The main thing that caused this crisis was actually a subprime lending crisis. And what is subprime lending? It's actually where mortgage brokers would go out and they would offer loans to people who may or may not have been able to afford them. They basically would give them to people with incredibly low credit scores. They'd give these loans to people with no income verification. So you could go out and potentially get a loan without even having a job to be able to pay that loan back. They also were using ARMs, which are adjustable rate mortgages at the time. So this would be a mortgage where you come in with an introductory price, and then all of a sudden the rate adjusts after a period of time, typically a year or 2 years, and that rate actually would go up. And once that rate went up, the payment all of a sudden was something that people couldn't afford. Maybe it was something that under the original rate they could afford, but then all of a sudden they couldn't afford it. So what did this cause in the United States? Well, it caused the people to actually have a lot of foreclosures and not being able to afford their houses. So people were all of a sudden losing their houses and banks were having to foreclose on them. And when banks foreclose on the house, they actually have to turn around and try and sell the house again. Well, and all of a sudden, if you have all these houses going up for sale, the price of housing goes down. Why does the price of housing go down? Because all of a sudden we have this huge supply of houses where people have been foreclosed on, and those are going to the market. And if you're in the market for buying a house, all of a sudden you have lots and lots of different options for houses to buy. So you saw a drop in housing prices, and this caused a real issue for the banks who were sitting on some of these properties. In addition to this, you have the fact that these mortgage brokers that were giving some of these, in my opinion, somewhat unscrupulous loans with adjustable rates and no income verification, and giving it to people with super low credit scores that probably couldn't afford that house and are going to get foreclosed on. What the banks were doing is they were actually sending out that mortgage, and by that afternoon they were actually packaging up that mortgage and they were selling it to other banks. And what that essentially eliminated was it eliminated any form of accountability that the banks could have. Because normally if you sell someone something and it's bad, well then that bad thing is going to come back on the person who sold it. If you sell me a fake silver bar, all of a sudden I figure out it's fake, I'm coming back to you and I'm going to be looking for restitution with you. The problem with going ahead and giving the mortgage and then selling it to other banks is you'd go back and you'd be foreclosed on, but then that foreclosure wouldn't come back on the original bank who gave you the loan. It'd be coming back in some other bank. And a lot of times what they would be doing is they'd be packaging these securities or mortgage-backed securities with thousands of other loans. And this would be divided up and bought by lots and lots of different banks, lots and lots of different investors and hedge funds and pension managers. And these things were purchased, and it oftentimes was hard to even tell who the original owner of it was. And with that, it ended up affecting the whole U.S. stock market. You have a final factor where you actually had these banks that were issuing on these mortgage-backed securities. They were issuing insurance and saying, hey, these mortgage-backed securities are actually backed by real estate. We know the value is going to be stable. Well, newsflash, the value wasn't actually that stable, and it did go down because real estate investing is not a surefire bet, and it can go down. But they put out these insurance policies, and with these insurance policies, it's essentially saying, hey, if the value of this investment does in fact fail, we will actually insure it and make sure that you are whole. And the banks actually ended up kind of screwing themselves, and you might have heard of a famous insurance company, AIG, that went out of business in the 2008 financial crisis because that they actually offered too many of these insurance policies. These were called credit default swaps, and with these insurance policies, they actually had so many of them that it caused them to go out of business. It was like it wasn't possible for real estate to actually go down. But turns out real estate does go down in value sometimes, just like we've seen in the past our silver coins go down in value sometimes. Now, typically they do come right back up, and over time we see that the purchasing power is very stable for our silver coins and incredibly stable for our gold coins. And that's part of the draw of gold and silver as investments. And you actually saw a big pullback from people actually wanting to invest in stocks after the 2008 financial crisis. They had lost a lot of faith in these banks that were sending out these bad loans and then packaging the loans and selling them to other people. So, what are the things that we can actually do to prevent crises like this from happening in the future? Well, probably the biggest thing that we can do to actually prevent some of these crisis in the future is make sure that we are living within our means and we're not overextending ourselves like people did in the 2008 financial crisis. Because in the 2008 financial crisis, the root cause was these unscrupulous mortgage brokers sending out these loans for people who couldn't afford it. The biggest thing that we can do in our lives is making sure that we are staying out of debt and making sure that we are only getting into debt and only buying houses that we know that we can actually afford. And that's something that is really, really difficult, especially when you go into a bank and they say that you can afford something way, way bigger, and you have to be the one who is the voice of reason and says, hey, I don't need all of this stuff. I can actually live on something much, much smaller. In the future, we are going to talk more about how when we see these financial crises and we see people actually getting scared off of buying stocks, we actually see them going to safe haven assets like silver and like gold, because that's something that offers them a sense of security and peace of mind in a time when all of a sudden the value of their investments are dropping by a half. And that's something that we can kind of take advantage of and be aware of in the future. So we will get into that in our next video, and I would love to hear from you guys in the comment section below about what you actually learned about the 2008 financial crisis and what you learned from the 2008 financial crisis, because I always am interested in hearing your guys' perspectives. Take care.